Looking at the Markets with David Modell. Welcome to Looking at the Markets with David Modell. Today I'll be speaking with Mr. Jesse Felder. Jesse has been managing money for over 20 years. He began his professional career at Bear Stearns and later co-founded a multi-billion-dollar hedge fund firm headquartered in Santa Monica, California. Today he trades independently. He writes articles for Seeking Alpha and he publishes the Felder Report, which can be found on the web at thefelderreport.com. Link will be in the description. Mr. Felder, or you said I could call you Jesse, so I will. Jesse, thank you so much for joining me on Looking at the Markets.
Hey, I'm happy to be here, Dave. Thanks for having me.
Yeah, I definitely appreciate it. You are well known and highly regarded and sometimes a little controversial. Ooh, I'm looking at some of your articles here, and we'll touch upon those. First of all, how did you get into finance and investing and writing about investing and finance in the first place?
Well, you know, I actually was interested in finance at a young age. Actually, this might date me a little bit. I was, I think, 8 years old when my dad bought, maybe I was 10, first computer. It was the Apple IIe, and he got some super basic games for it. One of them was a game called Millionaire, which was basically a stock market simulator. And if you just search for it on YouTube, you'll find it, and it's probably the most boring game that you could ever imagine. But I was addicted to it, and I actually started looking at stock quotes on the weekends and kind of putting together a paper trading portfolio. And when I was a kid, and then when I graduated college, I just went to work straight away for Bear Stearns, and that's really how I got in the industry. But how I started writing about the markets was a little different. I started my blog, actually, I was just looking at my calendar for our appointment today, and tomorrow is, I think, my 12th blogiversary. So I started my blog 12 years ago. So that was May 2005, kind of in the heart of the real estate bubble. And I live here in Bend, Oregon, which, believe it or not, this little town was, for a couple of months there, either the number one or number two most overvalued real estate market in the country in 2005. So I kind of had a front row seat to some of the mania going on in the markets, and so I just started writing about it in middle of 2005, and that's really how I started blogging and writing about the markets and stuff 12 years ago.
And I'm glad you did start writing about it, because there's so much on your website, thefelderreport.com. Just wanted to talk about that before delving into some of your more interesting articles, which I think are a must-read. On the Felder Report, I see you've got premium services as well as your blog. What are the premium services that you have to offer?
It's pretty much just a newsletter. I try and write a free blog post, once a week. But for people looking at, for more in-depth commentary and actual trade ideas, I offer the newsletter too, which is, I write a weekly market comment, just stuff I find, interesting in the markets every week. And then I have a chart book that I update several times a week on just the charts, asset classes, individual securities that I'm watching and kind of what I think is going on. And then I have specific trade ideas, which I, update on from time to time.
Yeah, I'm looking at it right now. The premium services on thefelderreport.com include weekly insight, a powerful chart book, timely alerts, and I'm looking at all these testimonials from Peter Brandt and other greats. I mean, well deserved, absolutely. So people should definitely check that out, as well as checking out Jesse on Twitter as well as other social media is a must-read. We'll get back to that for sure. But I read something that says, here's why Jesse Felder never regretted the costliest decision of his life. Well, I've got to find out more about that. What was the costliest decision of your life?
Yeah, well, that dates back to the when I left Bear Stearns. I left with a guy who I worked for at Bear, who really kind of showed me the ropes in the industry, and we left to start a hedge fund in Santa Monica. This was late 90s, and we started the firm with about $100 million in assets, which might sound like a lot to some people, but was very, very small, by this, in hedge fund, terms.
Yeah.
So then we were running 2 or 3 different hedge funds over the next several years, and into the teeth of the .com mania. And so we had some differences of opinion on the way the assets should be managed, and really I think what I probably wrote about more in that article was the ethical concerns that I had at the time. And so I ended up quitting the firm in March of 2000, right around the peak of the .com bubble, and moving away out of LA into Central Oregon, middle of nowhere. I felt like I had to do it just from an ethical perspective. And the fund went on to, from a few $100 million at the time I left to managing $11-12 billion back in 2011-12. So over the next 10 years, they grew substantially. And I was a large owner in the firm, and so I would have stood to benefit greatly from that. But leaving, the firm when I did, probably cost me a ton of money. But in 2012, the SEC investigated the firm, and the whole thing kind of came tumbling down. And so, I think the writing was on the wall back in 2000 when I quit. And like I said, so that's why I don't regret leaving, because I think if people are faced with these types of decisions in your life, maybe just once or twice, to make a decision like that, and for me, it wasn't a hard decision to make. It was I didn't feel right with the way things were going, and so had to move on.
And I'd say you did the right thing, and that's for everybody's benefit, because since then you've put out some amazing content. Wanted to talk about some really interesting article titles, which I've read them, but I'm still fascinated with these, such as how the passive investing mania undermined its most basic assumption. Well, what is the most basic assumption, and how did this mania undermine it?
Yeah, I mean that's a good question. You're testing my memory on my own posts. I write so many of them up. But yeah, this one, passive investing is really it came out of the efficient market hypothesis, which suggests that all available information is accurately reflected in stock prices. And so, if you were to just buy all stocks in the market, you should be able to capture or share in the performance of those businesses over a period of time. But this huge push to passive investing that we've seen, I think I just saw something today. There's now more than $4 trillion in the ETFs, and passive funds are set to overtake active funds sometime in the next 9 months. So, but the shift from active to passive is basically going from being a price-sensitive buyer to a price-insensitive buyer. And just this massive shift to price-insensitive strategies, mainly passive investing, has made the markets, and you can look at it in a variety of different ways, but it's made the markets less efficient than ever before. Yeah. So, I mean, Steve Bregman gave a great presentation on this recently. We talked about ExxonMobil as kind of the poster boy for this, that if you had in 2012 been given the financial statements of ExxonMobil, 3 years in the future, 4 years in the future, and bet that the stock, seeing that, oh, wow, the oil price is going to crash, their earnings are going to crash also, they're going to be paying out more in dividends than they're actually earning, for several years. You'd logically bet that the stock price would go down, but it hasn't gone down, and that's simply a function of the stock has such a high float and such liquidity that it appears in every single ETF, essentially, that you'll find. I mean, it's probably more prevalent in ETFs and passive products than any other individual stock. And so, the stock price has not reflected the business reality over the last few years. And like I said, that's just one example of kind of how the markets have been pushed by passive investing to, well beyond what's fundamentally justified. So, passive investing is built on the idea the markets are efficient, but the popularity of passive investing has created the greatest inefficiencies that we've ever seen in the markets.
When your Uber driver tells you to sell naked put options, that's another article title. And that's a reference, I'm assuming, to the old saying that if your shoeshine boy tells you to buy stocks, that's probably the top of the market, or at least it's close. And we're not calling market tops here. This is not investment advisement in any way, shape, or form. Disclaimer. But yeah, when your Uber driver tells you to start selling naked puts, that's probably a bad sign. Would you agree?
Yeah, and you're absolutely right. It was that was the 1929, the Roaring Twenties market, and Bernard Baruch was talking about the days leading up to the 1929 crash. One of the things he said is, taxi drivers were telling you what to buy. So this is, I think, today's version of the Bernard Baruch quote, which is, Uber drivers, and I tweeted something about the selling put options and shorting volatility trades, which have become so popular in the last few years. And somebody on Twitter, just answered me by saying, I literally, my Uber driver's telling me to sell naked put options. And, for me, that's a sign that, the risk taking has become so great, so extreme, but also so prevalent among investors, that they've become so much more comfortable with, taking greater risk, that it's, usually a pretty good sign of where you are in the cycle. And so we're in the late innings of this bull market, I think.
Now, we're not top callers here, but should people be hedging? For example, you have an ETF portfolio. Are you heavier on commodities, maybe gold and silver as a hedge, or are you still mostly long equities?
So in my ETF portfolio, I basically use a tactical ETF portfolio just to kind of demonstrate which asset classes I like at any given time. And, I would say yes, in terms of equities, you want to be at your most conservative positioning, whatever that is, whether you use hedges or not. I don't think of really gold as a hedge so much as, one of my favorite charts is the ratio of financial assets to real assets. And you can see when financial assets get very expensive relative to real, or when real assets get very expensive relative to financial assets. And today, real assets have never been cheaper relative to financial assets in history, in at least 100 years of the history of this chart. So I just think gold is, as the poster child for real assets, has probably never been cheaper relative to financial assets, namely stocks and bonds. And from that standpoint, as a diehard value investor, contrarian, gold's one of my favorite asset classes right now.
Yeah, I'm actually looking at SLV, the ETF for silver right now. It went down a crazy 13 consecutive days, still looking very weak. But I'm looking to load up a little bit myself. So how? If gold is not a risk hedge necessarily, how are you hedging risk in your portfolio or in your trading or investing in general?
That's a good question. I like to be long and short most of the time. So I do have some long ideas that I really like and own, and then I use short selling essentially to hedge my long ideas. So I'm short a couple of index ETFs along with some individual stocks. But I think for most people, short selling is not the best way to go about this. I think just reducing your exposure by selling down your equities to whatever, not from necessarily a market timing perspective, but just saying whatever my most conservative position is, that's where I should be. For some people, I've been asked a lot, how do I, if I own a lot of stocks and individual stocks, I don't want to take capital gains, then I think I do have on my website a simple tail hedging strategy. It's just a strategy that entails buying put options, out of the money put options, as a way to hedge your long exposure. And I have to give credit for that idea to Mark Spitznagel, who runs a tail hedging fund. But I stole this tail hedging strategy from his book, The Tao of Capital.
but I'm guessing that you made it your own. And so, it belongs to all of us, right? Why not?
Right.
So there you go. A couple more questions if I may, but in the meantime, I'm going to recommend people go to thefelderreports.com. By the way, where are you located on social media? What is your Twitter, Facebook, etc.?
On Twitter, it's just at Jesse Felder, and I actually do share a lot of what I'm reading there. So that's I'm pretty active on Twitter. Aside from that, I'm not on Facebook or anything else. So it's really just Twitter for me.
Yeah, stock twits, not for you.
I used it for a long time, and I really like what Howard Lindzen and company have built there.
Sure.
But I think it's really geared much towards more shorter term traders, and for me, I'm a longer term guy. So
right. Nothing wrong with that, and I've noticed that tendency on stock twits. So here's a question. I'm going to throw a curveball at you. Let's see how you handle this one. Was there ever a time when you let ego get in the way of your trading or investing?
Oh, great question. Yeah, that's really one of the biggest challenges we all face, right? And I have a friend who, I think he uses the Twitter handle mistrade because. He focuses on the trades he misses, but he also tries to think a lot less like a man because we have so much ego, and think more like a woman who maybe has a little bit less ego about her trading. I think that one of the biggest mistakes that I've made in my career was investing in a for-profit college a few years ago when the stocks got hammered and got really cheap and looked good from just a fundamental standpoint. But I underestimated the government's willingness to essentially put this entire industry out of business. There aren't many for-profit colleges left that are public companies, at least. I think, University of Phoenix, Apollo Group went private or was, bought out by private equity. I owned Corinthian College's stock, and the government essentially put them out of business. And I didn't pay attention to the market, which is telling me the stock is a loser and it's going down, and I should have sold it much sooner than I did. So I don't know if that was probably ego, to the extent that. But value investors always are kind of famous for falling into these value traps. So it's for me, it's about developing strategies to prevent me from making those kind of mistakes over and over again.
Yeah, and you know what? No investor, no matter how good, is perfect. We're all humans here, and we're going to make these kind of mistakes. But I know that your returns and your yield are quite impressive, and so we make up for these, and we learn from them, and we move on. And finally, one more, if I may. The good old 60% S&P 500. 40% TLT bonds, whatever. That combination worked for many years, decades even. Can that work anymore? Is there anything left to squeeze from that, or are we talking about very low returns from a stocks bond mix?
I think the most anyone can expect from a 60-40 portfolio over the next 10 years is 2% a year. Returns, and that's. Wow. Nominal. That's not real. So wherever inflation runs, it's probably zero after inflation. Yeah. My friend John Hussman has done some fantastic research on this, HussmanFunds.com, and he has some of the best forecasting tools for long-term forecasting tools for these things that I've seen. And by his assessment, the future 10 to 12-year returns for a 60-40 portfolio from today's prices are the worst in at least 100 years, just because bond yields are so low, stock valuations are so high, so that the return is not going to be, the forward return is probably the worst that we've ever seen. And one of the things that I worry most about it is that so many investors are relying on these types of portfolios on the fact that they're diversified, or on the belief that they're diversified, that if stocks go down, bonds will go up, or if interest rates go up and bonds go down, then stocks will keep pace with inflation. I think that's one belief that could be dangerous. That there is a possibility, we've seen it before, where stocks and bonds go down in tandem, and so I think it really pays to diversify into real assets, at today, that if financial assets do go down in tandem, you're going to want to own something else that makes you, helps you be truly diversified and not just in stocks and bonds. So
right, and if people want to find out exactly what that might entail, hey, they're just going to have to read the Felder Report, right? And they're going to have to check out your website, thefelderreport.com. Also on social media, Twitter especially, check that out. Mr. Jesse Felder, so much wisdom I've gained today. Thank you so much for joining me on Looking at the Markets. I really appreciate it.
Hey, thanks for having me, David. It was my pleasure.
All right, thank you.